What's up, guys? Welcome to another Market Radar podcast. Hope you've had a great week. We saw the NASDAQ and the S&P finally break out of their consolidation, which lasted quite a few weeks now, and with the help of CPI. So CPI numbers, if you're not aware, came in below expectations, driving up the NASDAQ, driving up the S&P, and now we're back up to new 52-week highs. So the question is this a bear market rally or is this the new bull market? What do you think?
Yeah, it's definitely a bull market. I know a lot of people don't want to hear that, but it's the realistic answer, right? So now, what does that mean, right? In terms of pricing, it's a bull market, so should stocks go up? The answer to that's a little bit more complicated. And how do I know it's a bull market? Well, it's not because we took out this high. It's not because we took out this high. It's because we're bullish trend. So bullish trends are bull markets. Bearish trends are bear markets, right? So when the trend is indicated via our proprietary trading view indicator that everyone can access as a subscriber, and the background's illuminated either red or green or white. White being neutral, red being bearish, green being bullish. So the Nasdaq went bullish trend here back in March of 2023 this year. So right around the end of the first quarter, Nasdaq goes bullish. The bull market initiates, and we've been in one ever since.
Yeah.
Now,
And one of the main rules that we have is do not short bullish trends. We do not short bullish trends at all. There are quite a few people that have been shorting this rally, and it's really just even now people are saying, okay, now it's overextended. Now it's time to short. It's not. It really isn't. The risk to reward just isn't there. Bullish trends tend to lead to higher prices. There's a lot of momentum involved in these kind of moves. Shorting it here, it's equivalent to catching a falling knife, and that's why we don't do it.
right, exactly. And so now, what I started off in the podcast in saying is, can the price continue? And that's obviously a bit more complicated. What I mean by that is you need the regime to align. So you can't just have a trend and expect the entire market to operate in that manner. I'm talking about all asset classes in all directions working in the same manner as just the NASDAQ trend. It doesn't work like that, right? So where I'm going with that basically is just because the NASDAQ is bullish trend, and if you understand DDAP, you understand that the trend level right now is 13,500 roughly. It's the orange line, Momo. We call it Momo. And as long as price stays above Momo, the trend should remain bullish. So price can come down from 15,700 down to 13,500 and still remain bullish trend, which might confuse many people. A lot of people would get excited with such a move, right? If you're coming down from here all the way down to Momo, it's like 14%. Everyone would call that, then you'll start getting all the perma bears come out and say the lows aren't in, we're going into a depression. You know how this stuff goes. It's pretty
Yeah,
cyclical,
of course,
right?
of course. And then
So,
at that point, it's like, oh, this was all just a bear market rally. That's what's going to
right.
happen.
But in reality, it's not. In reality, this is a bull market rally until the trend flips back to bearish. Just how when we were in bearish trend back and throughout pretty much all of last year, it was very easy. We called pretty much every one of these bear market rallies, and they were just that. All these moves were bear market rallies here, 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 and even here. And this was the bear market rally that turned to the new bull market. And that's how markets work, right? There's dips. So in a bull market, you have dips that recover, and they're just the buy the dips, and then eventually you get the dip that turns into the bear market. And in bear markets, you have the bear market rallies that are rallies and fades, and then you eventually get that bear market rally that turns into a new bull market. And again, this doesn't mean that the Nasdaq's headed to 18,000. Doesn't mean that. It just means that price structure is supportive for higher prices in the Nasdaq. But you have to also put into account where the economy is and how you measure the economy. And that's where our system is very important in our decision-making process. And that is something that we provide in our daily reports on a refreshed on a daily basis. And it gives us our risk sentiment gauge along with where we think, or I should say, our model positioning based off of our risk sentiment gauges, the system, and DDAP, our trend models. They all get converged into one. They're all converged into one simple output, and that being, for example, our Aries positioning. Our Aries model is our long bond and gold or long equity model. And these things are updated on a daily basis. And if you just look at one side of the equation, it's very easy to get it's very easy to feel a certain way about the market, right? Like a lot of people are like, oh gosh, the market's up a lot. This is it. The lows are in. We did say, by the way, we've been saying for months now, the lows are most likely in. The only problem is if this is a bull market rally, and then you're going to get you're going to get some bull market chop, right? And we've seen that happen time and time again in the markets where the market's bullish, but price is supportive, but it's not really supportive to the point where we actually start to see substantial increases in price over the longer term. Now, could this time be different? 100%. We're not going to get everything right in the markets at every turn and every pivot. It's impossible, right? You have to take the meat of the moves when you see them and pretty much take advantage of as many moves as you can, compound them, and then put together sizable long-term returns. It's really all you want to do. You don't want to sit here and micromanage every tick in the market, because what ends up happening is you end up overcompensating. If it's a model, you end up overfitting the model, and you end up with a very choppy and not, or I should say, non-scalable solution to markets, right? You're not able to really replicate at a higher degree of what you thought you could, and you end up just chopping yourself to death. And that's something we don't want to do. Okay, so let's go over bonds. So obviously, last week we had headline CPI come in at 3% year over year, and core CPI came in at 4.8% year over year. And obviously, we've spoken about this a lot. We've put out a lot of content in regards to core. Core is a lagging indicator. It is something that we don't really put much focus on. A lot of people like to take the month over month and then annualize it forward and like get different numbers on where core could go, or where core might be. It's a bunch of noise. Pay attention to headline. Headline comes in under estimates, and bonds go up, right? So bonds go up. Long bonds are trading back above mid vamp now. Still in bearish trend, but they are moving higher. So that's great. It's obviously showing that the fight on inflation is dying. Now, we also had PPI come out this week, 0.1% year over year on the headline PPI. That's great. Core at 2.4% year over year. Again, that's a lagging indicator. Headline is pretty much almost at zero for PPI. That's wonderful, right? In terms of the fight of inflation. The only problem here now, some of you guys might be looking at this chart. Obviously, I like to annotate all the CPI releases on my chart, because specifically on bonds, because I get to see how the bond market's reacting to inflation prints. Now, if you take a look at this, you might be saying, well, the bond market's subsequently lower after all of the prior 3 CPI prints. What is going on here? Why is CPI coming in lower and the bond market is down over the last 3 prints? The answer to that is very simple. It's the expectations of the Fed, where the Fed's going to bring rates to, where they're going to pause, and also how long they're going to hold at that level that they pause at. These are all factors that will affect the bond market, especially longer term maturities like T-bonds.
Right. So back in March, the federal funds futures were pricing in rate cuts coming in soon.
Right.
And
exactly.
So as time went on, those rate cuts were fully being priced out, and now we're not seeing rate cuts being priced in until next year.
Yeah, and that's something that's, again, let's talk about, I'll reiterate what Powell said a few weeks ago at the FOMC meeting, where he goes, rate cuts aren't going to happen for years. I don't think that's realistic. I think that, again, we've said this a bunch of times, the Fed either has to be dovish or they have to be hawkish. They can't really just be in the middle saying, oh, whatever happens, happens. They have to be like, if they have to be in a position where they're pointing towards a direction. If inflation is still an issue, they have to be hawkish, right? And if they're going to make a policy move, if they are going to pause, they have to emphasize into market expectations that they will remain on the edge of maximum hawkishness no matter what happened. Like if things start to break, they will move. Like that's what they want to basically play into the market's idea of how the Fed would handle inflation going forward from here, and they have to be very hawkish in that manner, making sure the markets believe what they're saying. So that's why the market's very sensitive. The Fed is very sensitive when they talk about how hawkish they're going to be, and it's not so much. They've pretty much deviated away from the extensive hiking process to more of the duration process, right? They're talking about not cutting rates, talking about holding rates, remaining restrictive. All these things that they're saying, they're not really saying that they're going to bring rates substantially higher from here, which we know the Fed will likely not bring rates much higher as long as inflation remains under the Fed funds rate, which currently at 3%. The Fed is rather restrictive, very restrictive actually, and we'll talk about how we can measure their restrictiveness shortly. But they remain very restrictive, and unless inflation starts picking up, the Fed's in a really good spot.
Right.
The only thing that we have to pay attention to now is these extra hikes. Now, I know a lot of people are probably like, well, is the Fed going to hike? Are they not going to hike? Is it one hike? Is it two hikes? And even if it's two hikes, it doesn't matter. The Nasdaq will not crash if the Fed hikes two more times. It doesn't mean the Nasdaq can't chop, as we said earlier, but in terms of, remember back in 2022, any further hikes drove the market lower, and like we just saw that kind of basically be erased from the markets as we hit into this new bull market here. All the fear of rate hikes, even though we're still hiking and we're into we're in the fives now, where we at some point in 2022 we weren't even expecting 5%, and we're there now and the market's a lot higher. Well, that just has to do with the overall idea of the soft landing, the Fed being able to pull off the impossible soft landing. We all know how that goes in the end, though. You can read our Twitter in terms of what we think about the impossible soft landing, why we call it impossible. But long story short, the market's setting itself up to basically not be as bad as 2022, right? If the market's not as bad as 2022, it's going to be hard to bring prices below those 2022 lows, which is why we said ever since we pretty much came off those lows into the new year, it's going to be hard for the market to break lower. And the market doesn't go down, especially from being down so deeply, it's going to bounce a bit. And that's what we've been seeing. So,
right. Well, so we had a theory just probably about a month ago. I don't quite remember when we came up with this theory, but the positive stock bond correlation on the way up is what we are expecting. Do you think this move in bonds is the start of that?
That's a good point. So I will be the first one to tell you that I thought this positive stock bond correlation would have come sooner. It obviously has not. Obviously, look, we could take a look at the Nasdaq and we can take a look at bonds. And we say Chads admit when they're wrong, right? And in this scenario, I am wrong. I thought the stock bond correlation was going to hold positive for a bit longer, but thankfully, I have Aries. It defended me. It protected me from my own narratives, right? This is why we like to focus our narratives around the system, not our system around the narratives. I did have a narrative that was a little bit outside of the system. The system corrected me, held me back, protected me. That's the important part of the system and why Aries is so unique. But long story short, what would happen with the stock bond correlation from here? I do think that at some point, the market's going to realize that the Fed's talking a lot of hot shit. Okay, they're like, "Oh, we're gonna hike, but like we all know that they're not going to hike. Now, let's roll this conversation into where the Fed's expected to go from here. Like we're looking at a 96% chance the Fed's going to hike in July and a 15% chance they're going to hike in September, with a terminal of about 5.4% rounded up, right? So we're at 5 roughly right now. So roughly 2 rate hikes, roughly, right, into the end of the year. And the Fed's expected to hold, and then we're expected to start seeing rate cuts in the middle of 2024. What that means is the bond market is laying that out and is understanding that, which is why it's moving up off the lows. It's realizing inflation is not that much of an issue. The Fed may not have to hold rates for that long. And the key here is going to be when the bond market starts realizing that the risk has shifted from Fed rate hikes and basically a yield curve inversion, right, where they're where the Fed's lifting rates on the front end so aggressively that it's inverting the yield curve, which is what we've been seeing here with the 2s and 10s going all the way down to almost negative 100 basis points, right? That's what's been inverting the yield curve. When we move from that narrative of yield curve inversion over to recession fears, what ends up happening is the long end of the yield curve will start going down, and it'll give this idea that the recession is coming, right? That there's demand for longer term securities, which longer term treasuries, which again indicates that there's a slowing in growth. Long story short, and this may actually invert the yield curve a little bit further, right? Because you're going to have the Fed pinning up front end rates, and the back end rates will actually drop, and it'll invert the yield curve, and then you'll get the recession. And at that point, the yield curve will be in a position where the Fed will have to cut rates, and now the Fed cutting rates is what will revert the yield curve. So we're in a position right now. I can even pull up the yield curve for anyone wondering what I'm talking about.
So the yield curve is actually going to invert more as a recession becomes more likely?
Well, yes and no. So the recession, so the way that this works is we're not going to go. I think everyone has this there's a consensus belief that we're going to hit a recession like 0 to 100. Like we're driving 100 miles an hour right now. We're going to hit a wall and go 100 to 0. I mean, right? We're going to just go dead stop recession. Things are going to start to break. The Fed is likely going to start to move rate. We're at 500 basis points. It's very unlikely we are going to go like let's call a recession right now. We don't know where the Fed would bring rates, right? Let's just call it recession half, 2.5%, right? Call it what it is. The Fed's not going to go from 500 basis points to 2.5% in one move, right? We know that in 3 meetings, they're not going to cut rates like that unless there was a really severe recession. So realistically, what's going to happen is inflation is going to stabilize and start moving lower, and we're going to have the Fed they're going to start fearing deflation. The market's going to know this. The long end of the yield curve is going to start going down, and the Fed's going to incrementally start reducing the front end of the yield curve, or the federal funds rate, which is going to bring down the front end of the yield curve, which is going to put a little bit of a war in between the spread, right? Because you have the front end, the 2s that are being weighted down by the Fed, or they'll front run the Fed a little bit, right? They don't have to wait exactly for the Fed to cut rates. As if Fed expectations for rate cuts do pick up, the 2s will start dropping, and the 10s will start dropping too. But at some point, the 2s will drop further than the 10s as the Fed brings down rates, right? Because the 10s right now are at 3.8%. Let's just say our hypothetical scenario where the Fed comes down to 2.5, the yield curve would be positive again. That would be a recession. Even if the 10s, like let's just say the 10s go down to 2 to 3, right, to 2.8, the yield curve would still be positive if the 2s go down to 2.5. The 2s are at 4.7 right now, which is why when you look at the yield curve, you have to understand that this is not an overnight light switch on, we're in a recession. It's the way you have to understand and perceive markets is like a work of art. It's every time is very unique, but it's all made with the same type of paint, the same artist. It's just every painting is different, right? It's painted you can't really paint the Mona Lisa twice, right? Like in terms of how this goes to, and talk about exact replica. There's always going to be some uniqueness behind it because it's art. It's emotional, right? And that's what markets are. So when the markets fluctuate from here, what's going to happen is the front end of the yield curve is likely going to remain stickier at the beginning. The yield curve could revert as we crack into the recession. But once the recession does come, it's confirmed, it's fully absorbed by the market and the Fed, the yield curve will be reverted. And the way that happens is obviously we have to first clear mid-vamp. So once we clear mid-vamp, Momo, sorry about that. Once we clear Momo at negative 62 basis points right now on the 2s and 10s, we get this thrust that we could start our trek into a recession. It doesn't mean that we're going to clear here and go right to 0 and then go right into a recession. Like I said, the pivot is going to be choppy because unless we go into a real hard, I'm talking like the closest thing that I can describe to you is like the SVB crisis, where literally in a week everything hits the fan. Unless that happens, which realistically those are black swan events, to bet that every recession is going to be an event like that or the GFC is nonsense. We all know recessions are not the GFC. They're not 2008, right? They're a lot less severe. typical recessions, right?
Hmm.
Now, a lot of people are like, oh, well, the Fed's hiking rates from 0 to 500 basis points, debt to GDP is over 100%. This is going to be the big kahuna, right? And I can tell you right now, sadly, a lot of the things you're reading on the Twitter are bullshit. Okay. In 2022, they wanted to tell you that there was going to be a housing crisis. Then they told you that there was going to be a banking crisis. There was collateral shortage. There was a liquidity crisis.
There was a
I mean, we can
war
go.
as well.
There was a war, right? That was going to bring inflation to the 20%. It's like it's I have yet to see FinTwit call anything right. I have yet to see them actually get a macro play from start to finish down to perfection. I'm talking about like, okay, here's a great example. The student loan repayment thing, right? That's coming up in the next 6 months, right? 6 months within the next year, we'll start to see student loan repayments come into effect in the market. Obviously, we have the commercial real estate thing too, right? You'd probably end up being a winning man placing the bet that the student loan repayments doesn't do anything, doesn't affect the market, at least to the degree that everyone thinks it does. You'd probably win that bet. And the reason is because if everybody's so concerned about it, typically in markets, it's priced in event. Everyone knows about it. You know? The reason why SVB was so tragic, because nobody knew about it.
Yeah. I don't know anybody that called that.
And I'm not talking about the regional banks. Like a lot, we could talk about KRE, right? Like KRE is like, oh, it's been bearish trend. It's been trending down, right? Like it was bearish trend. In February, it went neutral and then went slightly bullish, but then back to neutral rather quickly, and then it fell apart. But it was bearish trend before it shit the bed. So you could say like, yeah, KRE was bearish trend. That's step one, right? The Fed was hiking rates. That's step two. So there was a lot of pressure on regional banks, obviously with the SLR exemptions and a lot of these things. These regional banks were able to skate by during COVID, and once these things started to expire, they had issues, right? And this is what happens when you have concentrated risk. Obviously, to see this coming, this was not a common belief, right? But you know what was common? Once it did happen, everybody thought it would continue to happen, right?
Right. And then there's the contagion that comes in, so everyone's looking at other regional banks.
Right.
And yeah, then it becomes easy. But I want to go back to recessions and what to really expect. So
Okay.
likely what's going to happen is it's going to be a slow burn. So for example, if you're looking for the bond trade, it typically starts off with a slight uptrend, some chop. So the way I'm expecting it is we're going to head up above Momo over time, get some chop before really accelerating. So when the recession's going to start kind of slow and it's going to accelerate with momentum. And eventually the Fed's going to panic. They're going to have to cut as they always do. And that's what's really going to propel bonds. Is that a proper expectation to what's going to happen during a recession?
I think that's a very reasonable expectation, and it's something that, yeah, that type of mentality is a good mentality to have, because you don't get yourself overly excited for something that may not happen in the way that everyone thinks it's going to happen. What I mean by that is like everyone, it might be easy right now to say, you know what, I'm going to triple leverage long bonds right now. Get 3 times long bonds right here. Why not? Fed only can go down from here. It's all up for bonds, right? What you throw out the window is the possibility of chop risk, which we've been seeing here for the last 6 months. And if you throw that out the window, you throw your P&L and portfolio out the window with it. So you have to take a very modest approach to this. Like, let the market guide you. Like I said, the market's a piece of art. The market will paint the picture slowly, and you have to just be paying attention. The market's painting the sky. You just got to watch and make sure that the market is in fact painting the sky, and you position for it. Same thing if the market's painting grass. You're not going to play the sky play when they're painting grass. That means you're just not paying attention. You're a degenerate. Excuse me. You're just saying, you know what? I think they're gonna. This is the way the stock market trader thinks, right? Or the degen thinks. The painter's painting the grass. Degen goes, not, I'm gonna ride the grass wave. No. They go, I think he's going to paint the sky next. That's what they do. And then what ends up happening is he paints a tree and you're fucked. That's what happens. That's what happens in the markets. And that's the sad thing. People want to always front run every curve that they can. And if they were successful at doing so, they would be out of the market so quickly because they would have made such a large amount of money. But I've been telling you this we're doing podcasts over a year now. I've been telling you that nobody's timing every turn in the market 100% of the time. Just compound as many meat of the moves as you can. Stack cash. That's all you got to do. You don't have to sit here and time every tick. Oh, I gotta nail the bottom in bonds here, sell it up here, buy down here, sell out before we get another whacking. Like, you don't actually do. That's gambling. That's what that is, because you always have to set yourself up in the market to put the odds in your favor, right? And when we talk about odds in our favors, let's talk about like how we could use this in real life. Like, how do you put the odds in your favor, right? So let's talk about the Fed. And I said that we would talk about how they're restrictive and whatnot, right? So when we say the Fed's likely not going to hike anymore, now you have the Fed odds, the Fed rate hikes being off the table. Those are now odds that are in your favor. Now, why do we say the Fed's likely not going to hike anymore? A lot of you guys probably see us on Twitter. You're like, oh, how could you say the Fed's done? How could you make that statement? Everyone was saying inflation was transitory. The Fed was going to not hike above 400 basis points. Remember that whole escapade, right? That was crazy. Now the Fed's at 500 basis points. Why are you right this time? My answer to you is, I honestly don't think the Fed should hike in July this month. I don't think so. I don't think they should. But I'm a nobody, right? The Federal Reserve is the Federal Reserve. They are the institution. I'm just some random dude on a podcast, right? I'm not the Fed. They want to hike, they will hike. If the Fed wants to hike out of principle, there's no data that they can look at that say, you know what? It's not a good idea to hike. They're just going to do it. They're a lagging organization and they want to make a statement. They've destroyed their credibility. There's a possibility they do hike. I want to believe that the 96% chance probability that they're going to hike is overstated. I have this feeling they may not hike, but I could be dead wrong. That's okay. That's why we have the system and DDAP double checking what we're doing. So in terms of what the Fed is going to do, we have to look at why they would be so restrictive. And this is a nice chart that I like to use. It's the Fed funds rate minus the 5-year break evens. So we're taking the current Fed funds rate minus where future inflation is expected to be. And the Fed, if we were to use that, Fed is about as restrictive as they were in 2007, leading up into the GFC. So the Fed's really restrictive. A lot of the official Fed indicators that are referenced are very behind. And that's only because of the velocity of the hiking cycle. We went from rapid rate cuts in COVID to rapid rate hikes. So things went from super loose to super tight really quick. So a lot of these these core data sets, they're lagging by nature. They're not going to be able to keep up with they're not designed to keep up with this type of rapid monetary policy shifts, these rapid monetary policy shifts in such a short amount of time. So you have to give them you have to look at them with a grain of salt when you see them and say, Fed is most likely more restrictive than some of these lagging data sets are implying. And this is a good one because this shows you the Fed versus the forward market expectations of where the market thinks inflation is going to be. Long story short, Fed is really restrictive. There's no inflation's now at 3%. PPI is at 0 pretty much. There's really no reason for them to hike. All right, I think that's where we're going to wrap it up this week, guys. Thank you so much for listening. If you guys have any questions, you can reach out to us on Twitter at The Market Radar, or find more information about what we offer on our website at market-radar.com.